Welcome back to The Explainer. We're diving right into Section 5 today, Journal Entries in Worked Examples for ASC 340-40. Now, in our last section, we really did the heavy lifting, right? We tackled initial measurements, we went through impairment tests, but here's the reality check. Doing all that measurement math perfectly, it literally only matters if it hits your general ledger accurately. If the journal entry is wrong, well, your financial statements are wrong. It's as simple as that. So today, we're going to bridge that gap. We're translating those theoretical calculations into the real-world debits and credits you actually need to book.
Okay, let's dive into this. Here's our roadmap for today. We'll start with the overall journal entry landscape, then look at impairments and cancellations. After that, we'll walk through three very real-world examples: a SaaS subscription, an IT setup, and an annual renewal. Let's get to it.
First up, Section 1, the journal entry landscape, where we translate theory into practice.
So here's the big question. You've calculated all your costs, right? You've carefully identified whether they're costs to obtain a contract or costs to fulfill it, but how do you actually book them? It sounds simple, but this is exactly where the rubber meets the road. Remember, the pretty severe consequences we've talked about earlier in this series. If you misstate these assets, or say you record the expense in the totally wrong period, you are running a very real risk of distorting your EBITDA. And in the corporate world, creating an artificial bump or dip in EBITDA just because of a botched journal entry, yeah, that's exactly the kind of thing that leads to massive audit adjustments and some extremely uncomfortable conversations with your stakeholders. Nobody wants that.
Now, what's really interesting about this is the clear contrast between the two main actions happening in your accounting system. Over on the left, we've got capitalizing costs. Whether you're dealing with cost to obtain a contract, like a sales commission, or cost to fulfill it, like project setup labor, capitalizing basically means you're just parking those costs on the balance sheet as an asset. Why? Because this protects your current period profit and loss statement from taking a massive unfair hit all at once. Then, over on the right side, we have amortizing costs. Over the life of that contract, you systematically move a portion of that parked asset off the balance sheet and you recognize it as an expense on the income statement. Honestly, it's a beautiful mechanism for matching your expenses directly with the revenue they actually generate.
Moving on to Section 2, impairments and contract cancellations, basically handling the bad news entries. Because let's face it, sometimes things go sideways, and when they do, you're generally looking at one of two actions. First up is an impairment write-down. In plain terms, if your capitalized asset suddenly drops in value, meaning its carrying amount is now higher than the remaining consideration you actually expect to receive minus the direct costs, well, you have to write it down to reflect reality. The second scenario is a complete contract cancellation. Say a customer terminates early. That capitalized asset you've been so carefully amortizing, it suddenly has zero future economic benefit. You obviously can't keep an asset on the books for a contract that doesn't even exist anymore, right? So that entire remaining balance has to be written off to the income statement immediately.
All right, let's see how this builds with Section 3, Example 1. We'll look at a SaaS subscription and the reality of obtaining a contract.
Okay, let's lay out the parameters for this first contract. Imagine you sign a 3-year SaaS subscription on January 1st, year 1. The annual contract value is $24,000 a year. Now, to get this deal across the finish line, a commission of $3,600 was paid to the sales rep. That's exactly 15% of the year 1 annual recurring revenue. So first question, is this cost incremental? Absolutely, yes. The rep only got that commission because the contract was actually signed. Second question, can we just use the practical expedient here and expense it? No way. Why? Because the benefit period stretches across 3 full years. That is well over the 1-year threshold you need to use that expedient. Therefore, on January 1st, we literally have no choice but to capitalize that entire $3,600 as an asset on the balance sheet.
So, what does the periodic journal entry actually look like? It's pretty straightforward math. We take our $3,600 capitalized commission and simply divide it by the 3-year term. That gives us a required $1,200 annual amortization entry. So every single year, for 3 years, you're going to credit your contract asset and debit your commission expense for exactly $1,200. And there you go. That perfectly aligns the upfront cost of obtaining that customer with the 3 full years of revenue they're going to bring in.
Let's shift gears a bit. Section 4, Example 2, IT implementation setup, where we look at capitalizing fulfillment costs.
Here are the baseline facts for our second scenario. We've got a professional services IT implementation project. It's an 18-month engagement with a fixed fee of $500,000. But before the ongoing service delivery really hits its stride, there are setup and mobilization costs right at the very beginning.
Specifically, the company incurs $30,000 in direct labor costs that are dedicated purely to initial site analysis and planning.
Now, before we can just throw that 30 grand onto the balance sheet, we need to visually check off the 3 critical criteria that absolutely must be met to capitalize fulfillment costs. Step 1, does this $30,000 directly relate to this specific IT implementation contract? Yes, it's for site analysis for this exact client. Step 2, does it generate or enhance resources of the entity that will be used in satisfying performance obligations in the future? Yes, again, the planning and analysis create the actual framework needed to do the 18 months of work. And step 3, are these costs expected to be recovered? Yep, for sure. The $500,000 fixed fee more than covers that $30,000 setup cost. Because we hit all 3 of those criteria, we can confidently recognize that 30 grand as a capitalized fulfillment cost upon our initial entry.
And this brilliantly illustrates the matching principle in action. To find our monthly amortization, we just use straight-line division. We take the $30,000 and divide it over the 18-month project term. 30,000 divided by 18 gives us exactly $1,667. So every single month for a year and a half, you'll record an expense of $1,667, systematically drawing down that asset as you fulfill the project. Makes sense, right?
Which brings us to our final scenario. Section 5, Example 3, the annual renewal expedient, and how we simplify short-term contracts.
Let's set the stage for this one. We have an annual software maintenance contract. It's just a simple 12-month renewal. Upon signing this renewal, a $400 commission is paid out to the sales rep. Now notice the amortization period here is exactly equal to the 1-year contract term. Because that period is 12 months or less, the entity actually has a choice. And in this specific case, the entity has actively elected to use the practical expedient for contracts with an amortization period of 1 year or less.
Because the entity elected this expedient, they are actively choosing operational simplicity over asset creation. So, what does the journal entry look like? Well, there is no capitalization. There is no tedious 12-month amortization schedule to track. Instead, the accounting treatment is just an immediate expense. That $400 commission is booked straight to the income statement the exact moment it's incurred. Honestly, this saves the accounting team so much headache from tracking tiny little asset balances over short periods.
Now here is the crucial point, and you really have to remember this. You can't just pick and choose when to use the practical expedient based on, say, how your earnings look that particular month. The rules strictly demand proper policy disclosure. Your entity must officially disclose this election in its accounting policy notes. And furthermore, you absolutely must apply the exact same treatment consistently to all annual renewal contracts that have similar characteristics. When it comes to compliance, consistency is everything.
We've looked at the theory today, and we've manually walked through 3 very common examples. But I want to leave you with this provocative thought. Doing this manually for 3 examples on a whiteboard, that's easy. But are your actual company's systems and internal controls truly ready to translate ASC 34040 from theory into perfectly compliant, auditable journal entries every single period for thousands of contracts at a time? Doing that at scale requires some serious operational maturity. And frankly, that question perfectly sets the stage for the final boss in this series. Next time, in Section 6, we're going to tackle reporting, disclosure, and the precise internal controls required to keep your organization out of trouble. You definitely won't want to miss it.